Hey guys, thanks for coming by. I'm Nick, and this is Real Life Money, where we talk about topics that schools do not. So let's get started. In this video, we're going over what are student loans, and we're going to be explaining them a little bit, just going over the basics. Nothing too crazy, like always, and I'll be going over a little bit of my opinion at the end. So, why do people get student loans? Well, school's expensive. It's like a little bit more than a Starbucks coffee. That was a joke, but seriously, college is expensive. If you don't have the money to go for it, then you have to get student loans. You get these loans from either banks or even the government, so you can then go toward college. So as a little side note, I do have another video about is college worth it? So I won't go into too much detail. It really depends on your situation. Could be bad, could be good. I'll leave a link in the description for you guys. So let's just assume that a college degree is worth it for you. So you have to go to college to get that degree. So you can get that job that you want, the job that you need, whatever. It requires a degree. So you have to go to college to get it. So another quick option, whether this works with you or not, it is an option. Student loans are not required. You can get a job, whether part-time or full-time, work, get the money, and pay for the college. Or you could also go for scholarships. So let's start off with getting these loans. Generally, you get a loan for 1 academic year. So now once you have that loan from a bank or the government, whoever, you get disbursements. You actually get that money at least 2 times a year, could be more, because of the semesters. When one semester comes, you get a disbursement and you pay for it. So keeping it simple, you get a new loan every academic year. So at the end, when you graduate, you have a bunch of loans. Now, nothing really happens throughout college because you're in college. You don't have to pay for it yet. So what happens after you graduate? You throw your hat up in the air. You do a backflip and then you drink. Whatever it is, you drink. But after all that, the party's kinda over. So now you've graduated. What happens? Well, most loans have what's called a grace period. So what a grace period is that once you graduate, you have to set up your life. You have to start looking for jobs and actually getting into the working environment. So that's what a grace period is. You don't have to pay your student loans yet for maybe 6 to 9 months because you're setting up your life. At the end of that grace period, when hopefully you have a job set up, you're finally getting into the working environment and everything, you have to start paying these student loans. Imagine that, paying money that you owe. Now, quick reminder that you have multiple loans because you have to get one, keeping it basic, every year. So if you go to college for 4 years, you'll probably have 4 loans. So at the end, you should probably consolidate these loans. Consolidate, that's a big word. You get a lot of points when you use it on words with friends. What that means is that basically you're all these loans, 4 loans, making it smaller, all into 1 loan. Making a bunch of packages, wrapping it up into 1. Consolidation. Now, when you consolidate finally all into 1 loan, why you're kind of doing this is it's just easier. You have to write 1 check. So now once you do this, This is usually averaging over a 10-year span. So you're paying the loan over 10 years. You get this fixed interest rate, which means the interest rate is going to be the same throughout the length of the loan, which is around 10 years. And some fun facts. We're in the 2017 area, so the average student loan debt is actually just under $40,000, and the interest rate, of course, it ranges, but the average could be maybe 5 to 7%. Now that you hopefully have that job, you have to repay these student loans every single month. So now that's overall the basics of getting a loan, and now you're repaying it. You have to repay the money that you borrowed. Now I'm going to be going into the different repayment options. There are different ways that you can set it up for you personally. Now these are all the different repayment plans. Starting off with the most basic one is the standard repayment plan. That means it's the same interest rate, same payment every single month for the 10 years of the loan. So that's pretty basic. Now the next one is the graduated repayment plan. Now, how this is set up is that when you start the loan, you pay smaller payments. And then as the loan goes on, the payments get larger. This makes sense because when you graduate, generally, you make a smaller amount, and then as time goes on, you get promotions, better jobs, so you have more money, so you could pay larger payments. So you start small, and you get larger. Now this is kind of good, because you do have lower payments because when you graduate you have a lower income. But this is not so good because you're paying more interest in the beginning of the loan. So overall of the whole loan, you'll be paying more than just a standard loan. Now another repayment plan, which is kind of going off the last one, is income based. Kind of self-explanatory. The lower amount that you make, the lower the payments. The more money you make, the higher the payments. So the payments adjust up or down depending on your income. And the last repayment plan that I'm going to go over is the extended repayment plan. Keeping it basic. One good thing, one bad thing about it. It's extended for, instead of the 10 years, it could be extended to maybe 12, 20, 30 years. And the good thing about it is that it does make each payment, each monthly payment, smaller. This is because you have a longer amount of time to pay it off. The bad thing is, well, you have the loan longer for maybe 30 years, and over the whole length of the loan, you're going to be paying more because of the length, and you probably have a higher interest payment. So those are the repayment plans. But what if you're having difficulty paying these student loans back? So we're going to be talking about this because a lot of people do have trouble paying their student loans back. So first we're going to be talking about deferment. So deferment can happen, which is basically that your payments are put on pause. You don't have to pay them at that moment. This could be due to, majority of the reason is economic hardship, injury, disability, unemployment, or even military. All this stuff temporary, even going back to school, this could be a deferment as well. Now if you have a federal loan, which means if you had a loan from the government actually pays the interest during this time, this deferment. Now this deferment could be like 6 months, usually. It's a pause in the payments. That's all it is. You still owe it. Now, another thing is that if you are having trouble paying your student loans back, it is called forbearance that you could go into. This basically puts stop payments on your student loans. Now this stop payment, you don't have to pay these student loans back, for similar to the deferment of the 6 months. But you still get interest added into the loan. So you basically just don't get like late payments, different fees, penalties, and it doesn't hurt your credit if you don't pay it. It's still there. Interest is added up. Now the bad thing about student loans is that if you don't pay it back, it could really hurt your credit. You need credit so you can borrow money for, let's say, a house. So you could get a mortgage. You might not be able to actually get that mortgage, or if you do, your interest rate will be higher because people can't trust you if you have bad credit. Bad credit means you're not paying people back. So my opinion about student loans is that they suck. Guess what? If you don't pay back your student loans, whoever you borrowed it from, they're going to get their money sooner or later. They could actually take money away from your paychecks, from your tax refunds, and if you wait long enough, your Social Security from your retirement. They're getting their money back. Now here's an important mindset, is that student loans shouldn't be a way of life. Don't think that you'll always have these loans and you're going to have them until you die. Don't think like that. You should not only be making the minimum payments, you should be attacking these student loans like they are destroying your future and ripping food out of your mouth, because that's basically what they're doing. I say pay down these student loans, because when you finally pay it off, you don't have them anymore. You don't have monthly payments. So whatever they are, you don't have them now. So what could you do with that money? Now the mindset that I have is that since these loans have interest rates of like 5 to 7%, if you're paying it that down, you're saving money on interest, because you don't have to pay it anymore when you pay it down. So it's basically like, instead of putting money or like saving money in a savings account getting 0.1%, if you pay your loan down, it's kind of like you're getting an interest rate of the loan, 5 to 7%. And that is guaranteed. So when you finally pay off your loan, no more payments, and if you pay more than the minimum, over the lifespan of the loan, you could save hundreds or thousands of dollars in interest. So that's the basics, guys. Hopefully you learned a little bit about student loans, what to think of them, and why you want to rip them out of your life as soon as possible. So hopefully this opened your mind a bit. If you like, you can like and subscribe to my channel, Real Life Money. We go over real life and money because schools simply don't do that. And personal finance is in all of our lives, whether we like it or not. So thanks for watching, guys, and I'll see you in the next one.